Hi, everyone. Welcome to Unchained, your no-hype resource for all things crypto. I'm your host, Laura Shin, author of The Cryptopians. I started covering crypto 7 years ago, and as a senior editor at Forbes, was the first mainstream media reporter to cover cryptocurrency full-time. This is the May 20th, 2022 episode of Unchained. With the Crypto.com app, you can buy, earn, and spend crypto in one place. Download and get $25 with the code LAURA, link in the description. CoinChange is the easiest way to earn passive income using crypto. You can safely deposit cash or cryptocurrencies to earn up to 20% annual yield. There is no lending or market risk, just simple, high-return yield farming. Create an account today at trydefi.cc/UNC and receive 40 USDC. That's trydefi.cc/UNC. If you're trying to break into Web3 or help build it, you'll want to come to Graph Day from June 2nd through the 5th in San Francisco. Get your ticket at thegraph.com/graphday. Today's guest is Tascha Che, founder of Tascha Labs. Welcome, Tascha.
Hi, Laura. How are you?
Great. So happy to have you here. This week, you wrote an epic thread on the collapse of Terra and Luna. And what you said were that there were 5 non-obvious lessons from this fiasco. Before we get to those, can you give people a general summary of what kind of business you think the stablecoin business actually is?
So in general, I think, stablecoin is in the business of transforming risk or volatility. So the buyer of stablecoin, average users, you don't like volatility of your token prices going up and down. You prefer to hold a stable valued asset. So that's why you buy stablecoins. So basically, you sell that volatility to the stablecoin protocol, and they buy the volatility, and they give you this asset that promised to always be priced at 1. So it's like in that sense, you can think of them as in a insurance business that ensuring there's some kind of a price stability of your asset, or you can think of them as in the banking business. Basically, you deposit variable priced assets, and they give you this certificate, meaning the stablecoin that is priced at 1, that has 0% interest rate per se, right? And then basically you hold that certificate, and it's promised to be worth $1. So I think when you look at stablecoin protocols, how they make money, right? So where does the value added come from? Part of value added is they provide a service of guaranteeing the stable price. So that is a feature that is demanded in the market. That's why it has a positive value added, right? And also, so that's also one way they can make money is have a surcharge to charge for the service that they provide. In terms of specifically how this charge is operationally being collected, whether it's through a redemption fee, whether it's through a token that is served as a signing or rich equity token, or some other mechanisms, that specific can vary, but this is one service, value-added service they can provide. The other way they can make money is obviously through some kind of arbitrage of tokens. If you deposit variable priced tokens that has limited supply, so over time, other things equal, those token prices should go up vis-a-vis US dollars, which has a nominal depreciation. You can think of the nominal GDP, because the money supply of US dollar grows broadly aligned with the nominal GDP growth, which is about 5-6% a year. So you think of that as a nominal depreciation against the fixed supply assets of USD token. So in that sense, over the long run, these protocols, there is a long-term arbitrage opportunity there, even if they don't do anything short-term investment with your assets. So that's how I look at these. You can think of that as an insurance business, as a banking business.
And in your tweet thread, you laid out what seems to be a viable scenario in which a stablecoin issuer could make money. But obviously, with TerraLuna, things went wildly wrong. What do you think caused TerraLuna's downfall?
Okay, so this is a very interesting question because, after the Luna fall, a lot of people are saying, okay, undercollateralized stablecoin definitely do not work. Well, I think that's wrong. I think they definitely do work. Why do I think so? Because they do work in real life. There are about 200 fiat currency in the world, and about 40% of them run a fixed exchange rate, either vis-a-vis US dollar or vis-a-vis a euro or a basket of currencies. So you can think of 30, 40% of fiat currencies in the world try to maintain a stable peg versus a larger fiat token. And about 30% of them runs a so-called floating exchange rate, and the rest of them are sort of in between. So central banks usually, monitor the value of their currencies, their exchange rate, to make sure it's stable. It fluctuates in a, kind of a predefined band, but it's not like a fixed per se. But my point is, a lot of the fiat currencies in the world, you can think of them as stable coins. And they are undercollateralized. Why? Because you can look at foreign reserve to broad money ratios of all the fiat currencies in the world. I think on the average, it's like 35%. So it's not like if you have a fixed exchange rate vis-a-vis the US dollar. For example, if you're UAE, right? If you're Panama, you run a fixed exchange rate vis-a-vis US dollar. But does that mean that every money that you issue is backed by $1 of USD? No. It's about, again, 35% reserve to broad money ratio. That's the average. So you can say, oh, all these fixed exchange rate tokens, they are under-collateralized stable coins. But there are some important differences here. Then, obviously the question is, okay, why do these work? Why, why does Luna not work? I think the most important difference here is that does the token itself, does this currency itself have a uncorrelated demand? What's the demand for a stable asset? So in fiat currencies cases, every country is, you can think of it as a sovereign economic system. So you have real world trade and commerce activities. Those all use the local fiat currency. So it's part of the local economic system, and its demand is being supported by the real economic activities. You use these to pay transactions. Local prices are priced in local currency. Governments use these to accept tax payments, and they pay their employees of public sector using their local currency. So all these activities are using the local currency as a medium exchange and a unit of account, and those are the organic natural demand for the local currency that is, uncorrelated with the need to peg against the US dollar or not. So that means, you have a natural floor of demand as long as the economic activities does not go to zero, which is pretty improbable. But if you look at online stablecoins, you do not have that. Luna, for example, UST is supported by the Luna token, which you can think of it as the collateral asset for the UST. But Luna has a ecosystem, yes, but it's very, very small compared to any of the real economies, even the small nation states. So you have in the Luna ecosystem, 70, 80% of the TVL used to be the anchor protocol, which was entirely riding on the UST deposit rate of being like a 20%, right? So that's entirely tied to UST, and you also the rest of the ecosystem liquidity, a large part of it is just Luna staking, token staking, and you have some DeFi protocols, but those also tend to center around the use case of Luna and UST. So the ecosystem is quite small. You don't have the luxury of a typical fiat currency being like as a reserve, as a asset, collateral asset with uncorrelated demand.
Yeah, and you sort of started to hint at this, but another part of the tweet thread was that you said another lesson from this was that fast expansion without actual network effect equals, and then you put a skull and crossbones, which you were kind of implying that Anchor kind of drew a lot of people in really fast, but that it wasn't actually creating a network effect, which which also really struck me. I don't know if you wanted to add more on that.
Yeah, so back in the days, I put out some tweets on Twitter about the sustainability of Luna, and then the Luna tribe tried to argue with me and say, look at the UST adoption growing so fast, there's a huge network effect. In my view, there's zero network effect for a stablecoin because your stablecoin is a utility product. The entire feature of the stablecoin is to guarantee it's worth $1. If you take that feature away, there's nothing left. So this is another important differentiation from any fiat currency that runs a fixed exchange rate, because you can have a fiat token. You can peg to US dollar. You have a stable exchange rate. That's all well and good, but you are your own sovereign currency. The feature or the selling point of your currency is not like you're worth $1. The selling point is you're providing a service in real economy as a medium exchange and the unit account in your own economy. So if you cannot maintain that, if you can maintain a $1 peg, great. If you cannot, well, that's not the end of the world. You still have a economic ecosystem that runs on your local currency. Versus the stable coin, the entire value proposition rides on the point that you are being worth $1. If you take that away, nothing is left. That's why I think it's kind of a misguided effort for a lot of algo stablecoin protocols to try to business dev their adoption, try to get into more DeFi protocols to be used as collaterals or involved in DeFi borrowing and lending, or to get on other chains. I think all these efforts, if your underlying collateral assets do not have a good network effect, like a fiat currency does, then most of these efforts will be wasted. Because if you lose a peg, it's like that's the game over.
Yeah. So in a moment, we're going to talk about also the network effect for the reserve asset. But first, a quick word from the sponsors who make this show possible. Graph Day will be a giant leap in the growth of Web3. Whether you're just breaking into Web3 or already building and defining it, the future will meet the present in SF, June 2nd through 5th. Come meet and party with your online friends IRL and hear cutting-edge developments in the Web3 stack, revealed by Web3 founders and visionaries pushing forward decentralized protocols and applications. Then build at GraphHack, compete for over $400,000 worth of bounties, and learn best practices from top developers in the space, like Nader Dabit and Camila Ramos. Get your ticket at thegraph.com/graphday. It's time to bring Wall Street to Main Street. CoinChange is democratizing access to wealth management with low-risk, high-return, passive income through DeFi. It's simple. Just deposit your crypto into a CoinChange high-yield account to earn more over time. Your yield is paid out daily and can be withdrawn anytime. CoinChange's yield farming doesn't utilize lending or other risky strategies. No minimums, no obligations, just high yield. It's time for a change. Create an account today at trydefi.cc/UNC to receive 40 USDC. That's trydefi.cc/UNC. Back to my conversation with Tascha. So another point, again, that just really struck me was that you said it's a network effect for the reserve asset, in this case for Luna, not for the stablecoin itself that matters. And that to me said everything, because that was precisely why Luna just plummeted the second that the peg wasn't holding, because the only reason for its existence was just to try to prop up UST. But since that was already falling, there was no other reason for anybody to try to own Luna and frankly hold on to it rather than sell it immediately. So yeah, which I just thought was so spot on. But do you want to talk about that point, and then also another one of your takeaways, which was you said smaller is beautiful, which I believe you were referring to just the general ecosystem of any particular stablecoin.
Mm-hmm. Yeah. So the network effect, to me, the closest resemblance I can think of as a typical fiat currency in the crypto world would be the blockchain platforms native token for those blockchain platforms that has a more diverse set of use cases. So I'm talking like Ethereum, or even you can include newer ones like Solana, Avalanche. These are apparently all very new, so their network effect is pretty weak, and all the use cases on chain are quite correlated. Right now, you have DeFi, you have NFT, not much anything else, right? But you can think of these still as like an emerging economic ecosystem. My framework of looking at these, platforms would be like, national economies in the metaverse. I think they're going to be, in coming years, a growth to be more complex, more diversified economic ecosystems that are similar, that mirrors the physical economies in the nation states. So I think the native tokens for those would be a good place to start in terms of thinking of your reserve assets. So And if you're like a stable coin that you have like a brand new reserve assets, like FRAX, for example, they have this essentially a senior share token, which is a FRAX share. So, but you think of this token, it doesn't have much of else use cases. Okay, you can use it like staking something in DeFi, but that's kind of a sort of a semi Ponzi-ish, use cases, I would say, right? So then you want to think about how do you create uncorrelated organic on-chain use cases for these collateral tokens. That the network effect for those tokens are going to shore up your demand when things go haywire. So that's one, and then like you said, I also mentioned smaller is beautiful because obviously when you invest in any enterprise, any project, any stablecoin project also, you want it to be big, you want it to make as much money as possible, right? To become the market leader. But this is also a kind of a special case, a special sector, because it's really a crucial infrastructure in the on-chain economy for any like a blockchain platform. So you think of, if you build a new layer ones, what kind of key infrastructure do you need? You need a bridge, you need an AMM, and you need a stablecoin. Those are like a key infrastructure for the on-chain like financial system to function smoothly. So I think it's already, this stablecoin sector already serves a very systemic importance role in the crypto economy. On top of that, so if these protocols grow really big, and like in the Luna case, they depacked and they don't have any lender of last resort to actually bail them out, to actually help to buy the UST, right? With the national economies in nation states, at least you have some lender of last resort of in international lending facilities that you can borrow from other countries essentially to temporarily like shore up the demand of your native fiat if you have drastic capital flight or something. So in the stablecoin world, you don't really have that. Whether we will see something like that being like a cross protocol insurance mechanism or lender of last resort that is private sector based, I don't know. But right now we don't. That means the bigger you are, the harder it is to find people to rescue you. Because there are a handful of the larger players with sufficient liquidities in the crypto space. You can name them. You can pretty much count them with your two hands. But if your market cap goes beyond that, if you like depass severely enough, you just really don't have people to rescue you. So I think the more healthy ecosystem would be if we have 10 to 20 smaller, medium-sized stablecoin projects. They have their own pegging designs. They have their own like separate collateral basis. That would be a more resilient ecosystem compared to what we have now, which you have USDT, USDC, and the third one used to be UST.
Yeah.
So yeah, I think this is something for the blockchain platforms themselves to think of. Obviously, like protocols like Near, they're already doing that. Though I don't know if their motivation is as I described. But if I were a layer one protocol, this will be something that I will build, or at least collaborate with some projects to build on my platform as a sort of a semi-public good, because this is like basic infrastructure. It's not necessarily I would necessarily need this stablecoin protocol to be super big, but it provides a key service on my platform. That's all. So I think a smaller in size, that in itself has more resilience built in.
And so at the moment, the Terra community is voting on a proposal put forward by Do Kwon, the co-founder of Terraform Labs, in which he would like to fork the chain and call the original chain Terra Classic, and basically give various people who held either Luna or Terra previously new tokens. What do you think of that plan? And also just in general, what do you think would be the best way for Terra to move forward?
Oh, I do not have the answer for Terra. Basically, but the thing is, if you well, you can argue, okay, you have brand name recognition, though right now, how much the brand equity is worth, whether it's positive value or negative value, I don't know. So, and you also have a community of people, right? Though, like a lot of people are pretty grudgy, like right now, pretty angry, right? So, if you have a new, if you want to build a new stable coin, you probably want to like over collateralize it, go with the more of a DAI model, for example, basically to make sure that the probability of this thing goes unpack is extremely small. If they want to revive the thing, I have no idea about the prospect of how successful that will be.
And you mentioned FRAX finance earlier, but given everything that you've said, which stablecoins are you excited about?
I'm excited about the USDC. I for you you can argue, okay, centralized, it can scale, confiscation risk, so on and so forth, but as at least it's backed by actual US dollar cash or liquid US dollar assets. So utility wise, you should, the peg should stay, you know. So if we're talking about stablecoin as a utility product, then this product fulfills its utility pretty well. Uh, So in terms of stable algo stablecoins, I think people are there are different designs. People are exploring different mechanisms, but I think there has been some consensus emerging that you need some kind of collateral. It cannot be just a dynamic adjustment, scheme like Luna. So the FRAX that I mentioned, they're one model, which is, if you think about it, it's kind of like a fiat currency that runs a pegged exchange rate because you are collateralized. Fiat currency, they have foreign reserves that they can use to open market operation to defend their currency. So in FRAX case, it's USDC, right? So it has foreign assets. It's the percentage of foreign assets should be pretty high. The rest of your collateral does not have uncorrelated demand on chain right now. So I think if you have a collateral token that has a strong network effect, the stronger it is, the lower your reserve ratio can be. As I said, the median reserve ratio for fiat currencies are 35%.
All right. Well, I guess this brings us to the last point that you made in your tweet thread, which is you said regulatory standards are a nuisance until they're not. So, what do you think will happen regulatory wise now that TerraLuna has imploded? And how do you think that will affect the growth of the stablecoin space from here on out?
Obviously, I'm not a government, so I cannot say what governments are thinking. So, but I think the trend is it's drawing a lot of attention, right? So, especially in the countries that issue the fiat currency that stable coins are pegged on, meaning United States, the regulators, should be thinking pretty hard about how to regulate this. And the frameworks they will use, like we mentioned at the beginning, you can think of these businesses as a similar business model as insurance or banking. So I think regulatory frameworks in those sectors should at least lend some viewpoints to the regulations of stablecoins. The other thing is there is also, when I say regulatory standards, it doesn't necessarily have to come from government, right? So the other day I posted on Twitter that, I think a stablecoin industry can use something like a Basel agreement. So if people are not familiar with the Basel agreement in international banking, it's basically a multilateral cross-country kind of standard, banking standard, set up in the 1980s after a bunch of banking crisis in the 70s in multiple countries. So, the Basel Agreement is like it has a set of standards. As a bank, your capital ratio should be this much, your leverage ratio should be this much, your liquidity ratio, so on and so forth, right? But Basel itself does not have any regulatory authority, so it's not like as a country's financial regulator it has the legal mandate to actually enforce any of this. It's just a international agreement. It's a best practice. If you want to join, great. If you don't want to join, nobody is forcing you. So, but if you join, this is a brownie point on your reputation, obviously, as a bank, right? So, it can facilitate. It can help if you comply with the Basel agreement. Other banks who do the same look at you favorably. They're more inclined to do business with you, and you have more confidence among your users. So again, this is all voluntary, set up as a multilateral agreement to preserve the reputation of the industry, essentially. Okay, so it's a public good that is not like legally enforced or enforced by, any country's regulatory regimes. So I think something similar will be, really useful for the stablecoin industry. Something that cross different protocols, come together to think about what would be the standards that the industry should abide by. Without having any like legal enforcement or outside regulators coming to regulation threat you bang on your head.
Yeah, some kind of mandate. Yeah, I totally agree. And by the way, people definitely should check out this thread, and you might have even put it into a post, I believe, or at least I feel like I saw a post on this. But you have a newsletter. Do you want to tell people where people can find that?
Yeah, sure. Just go to taschalabs.com/newsletter. It's a free newsletter. I put out, industry analysis and Web3 outlook to give people an edge and to make people smarter about this industry. It's totally free. It's just that I enjoy doing that. So
Great. Well, it's been so much fun having you on Unchained. Thanks for coming on the show.
glad to be here. Thank you.
Don't forget, next up is the weekly news recap. Stick around for This Week in Crypto after this short break. Join over 10 million people using Crypto.com, the easiest place to buy, earn, and spend over 150 cryptocurrencies. Spend your crypto anywhere using the Crypto.com Visa card. Get up to 8% cash back instantly, plus 100% rebates for your Netflix, Spotify, and Amazon Prime subscriptions. Download the Crypto.com app now and get $25 with the code LAURA. Link in the description. Thanks for tuning in to this week's news recap. Terra struggles to revive amidst infighting and regulatory pressure. In the wake of UST's collapse, the TerraLuna community sought a way forward, even as it demanded more details on what happened to the Luna Foundation Guard's $3 billion crypto reserve, and as regulators came knocking. Terraform Labs co-founder Do Kwon made two proposals to revive the chain. Both were massively criticized by the community, and even by big names like Ethereum creator Vitalik Buterin and Binance CEO Changpeng Zhao. Do Kwon's third proposal consisted of forking Terra into a new chain without an algorithmic stablecoin. The idea is to rename the current chain Terra Classic and the current native token as Luna Classic. The new chain, Kwon proposes, would be called Terra, with the native token Luna. The new chain would have 1 billion Luna tokens and would be airdropped across Luna and Classic stakers, Luna Classic holders, residual UST holders, and essential app developers of Terra Classic. The proposal was put out for an on-chain vote on Wednesday. As of press time Thursday afternoon, it seems it is going to pass, as it has the support of Terraform Labs and Terra Builders Alliance, a community of developers and builders within the Terra ecosystem. However, some validators are not fans. Allnode CEO Konstantin Boyko Romanovsky said to the block, "The whole governance process of this proposal looks like a dictatorship model. It looks like the launch of the new chain is decided even before voting is finished." As for the $3 billion in Bitcoin reserves, the Luna Foundation Guard, which was in charge of defending the UST peg with the Bitcoin, finally sheds some light on what happened. According to an announcement on Twitter, when UST started depegging, LFG said it converted the 80,000 Bitcoins, or $3.1 billion, in its reserve to UST to defend the peg. After the massive sell-off, it was left with a reserve of 313 Bitcoin, or $8 million. According to Elliptic, a blockchain analytics company, 52,000 Bitcoins were moved into Gemini and the remaining 28,000 were moved into Binance. However, Tom Robinson, co-founder of Elliptic, said to CoinDesk that beyond that, we can't really see how it's been used. In other related Terra news, South Korean authorities are now investigating the Terra collapse. A specialized financial crimes unit called Grim Reaper we'll look into the methods Terra Labs used to attract investors. Quant has been charged with tax evasion and faces a penalty of 100 billion won, or $78.5 million, for failing to pay corporate and income tax. The Terra Labs legal team resigned shortly after the crash, making these issues harder for Quant to navigate. Tether releases its long-awaited attestation report. On Thursday, Tether, or USDT, the world's largest US dollar stablecoin, released its first attestation report in 6 months. After the UST chaos, this report was highly anticipated, as investors have been cashing out of stablecoins, with USDT supply dropping $7 billion in the past few days alone. Tether reported a reduction in its commercial paper holdings by 17% from December 2021 through March 2022, from $24.2 billion to $19.9 billion. USDT has a market cap of $74 billion and is fully backed, according to the attestation made by accountancy firm MHA Cayman, which reported that USDT is backed by assets that amounted to at least $83 billion. This latest attestation further highlights that Tether is fully backed and that the composition of its reserves is strong, conservative, and liquid, said Paolo Ardoino, the CTO of Tether, in a statement. As promised, it demonstrates a commitment by the company to reduce its commercial paper investments. In other stablecoin news, DAI, an algorithmic stablecoin from the DeFi protocol Deuce Finance, lost its peg against the dollar this week. DAI is now trading around 60 cents according to CoinMarketCap, after hitting a low of 51.7 cents on Monday. Chinese Bitcoin miners are back. According to new data from the Cambridge Center for Alternative Finance, or CCAF, China has reclaimed its place as a Bitcoin mining world leader. Even after a ban that prohibited crypto trading and mining in China last year, the Asian country is now the second largest producer of hash rate. The data was disclosed in the Cambridge Bitcoin Electricity Consumption Index, or CBECI, whose goal is to map mining activity around the world based on the geolocational data reported by mining pools. In December 2021, China accounted for 21.1% of the global hash rate, with that figure dropping to 0% after the ban, as was shown by previous data from Cambridge. Web3 wallets had a big week. Robinhood, one of the biggest stock trading platforms in the US, said it plans to develop a new non-custodial mobile wallet for Web3. According to the company's blog, customers will be able to hold the keys for their own crypto and access dApps to trade and swap crypto with no network fees, store NFTs and connect to NFT marketplaces, earn yield using their assets, and access a variety of crypto assets. Robinhood's wallet will begin testing this summer and has a waitlist for early access. The company intends to have the product available for all its customers by the end of this year. Coinbase also announced the release of a Web3 wallet. Selected customers will have the ability to access Web3 decentralized applications directly from the Coinbase app. Users will be able to buy and hold NFTs, trade on DEXs, and even use some of the major DeFi platforms like Compound and Curve to borrow, lend, and swap tokens. Notably, Coinbase users will be able to explore decentralized applications without having to manage a recovery phrase. Multi-party computation technology allows this innovative experience and enables users to have a dedicated on-chain wallet that Coinbase helps keep secured. Crypto adoption ramps up. Cloudflare announced plans to run and fully stake Ethereum validator nodes, making it the first publicly traded company to make such a move, according to Evan Van Ness. Over the next few months, Cloudflare will launch and fully stake Ethereum validator nodes on the Cloudflare global network as the community approaches its transition from proof of work to proof of stake with the merge, the company said in its announcement. It added, "This is just the start of our commitment to help the next generation of Web3 networks." Additionally, Spotify will start testing NFTs on its platform, according to a report by Music Ally. Spotify will test NFTs with select users based in the US, and NFTs will appear under the artist's songs and albums, but users will need to go to an external marketplace to make their purchase. Here's another reminder: not your keys, not your coins. In light of Coinbase's announcement that the exchange would retain user assets in the event of a bankruptcy, officials from Joe Biden's administration are pressing Congress to demand cryptocurrency exchanges keep their customers' money separate from corporate funds. Don't think you actually own your tokens when you go into a digital wallet, said SEC Chair Gary Gensler. However, Gus Coldebella, partner at True Ventures, tweeted that the Biden administration's logic gets a lot wrong. Coldebella thinks the problem is how bankruptcy law treats exchange wallets. For this reason, a legitimate fix that forces cryptocurrency exchanges to keep their customers' money separate from their own corporate funds is no fix at all. It's not the source of the problem, and it doesn't solve the legal issue, he wrote. On a related note, SEC Chair Gary Gensler testified before the House Appropriations Subcommittee on Financial Services and General Government this week and asked for a bigger budget to control the crypto space. Two other regulation-adjacent stories caught my attention. Reuters reported that finance ministers from G7 countries are calling for more crypto legislation. In light of the recent turmoil in the crypto asset market, the G7 urges the FSB, or Financial Stability Board, to advance the swift development and implementation of consistent and comprehensive regulation, the ministers wrote in the draft document. Terra Labs, a blockchain analytics company, launched a platform for users to report crypto scams and other illicit activity. TRM is currently using raw data from the blockchain to create insights to investigate crypto frauds and financial crimes. For more info on TRM Labs, subscribe to my premium bulletin newsletter, where I did an exclusive interview with Ari Redboard, CEO. Testing. Ethereum Merge's biggest test is set for June. Ethereum's main public testnet, Ropsten, is set to go through the merge in June. Merging Ropsten is a huge testing milestone toward Ethereum's mainnet merge, which is projected to happen in a few months. The merge is the most anticipated event of the year in the Ethereum ecosystem. At that time, the Ethereum mainnet will transition from the proof-of-work consensus mechanism to proof-of-stake. Even though there is no exact date set for the merge, Ethereum core developer Preston Van Loon hinted on Twitter that it would happen sometime this year. Time for fun bits. Nobody has any Luna. Apparently, the only ones that lost millions of dollars in the TerraLunas fiasco were retail investors. According to some tweets and press releases, major VC firms and investment funds have confirmed that they had no or very little exposure to Luna. Among these companies are Pantera Capital, Galaxy Digital, Multicoin, Dragonfly, Framework, and Onjuno, which, disclosure, is a sponsor of my shows. On Wednesday, after saying nothing for more than 10 days, Galaxy Digital CEO Mike Novogratz broke his silence. He said Galaxy has no exposure to algorithmic stablecoins. This is coming from a man who has a tattoo of the Luna token on his arm. He said, "My tattoo will be a constant reminder that venture investing requires humility." On the latest episode of The Chopping Block, Dragonfly's Haseeb Qureshi said he wasn't inclined to believe all these stories. "Everyone I talk to says they are okay. Somebody must be lying," he said, laughing. In agreement with Haseeb, Kevin Zhou, the Chopping Block guest, added, "There is no way that's true, but what would be even more harrowing is that if it was true, it would mean that the insiders dumped on retail and got out unscratched." Eventually, a few companies admitted to having exposure to Luna. Delphi Digital said on Thursday it has a large unrealized loss, and Hashed Wallet, a venture fund, sold $3.5 billion, according to Unchained data. Thanks so much for joining us today. To learn more about Tascha, stablecoins, and the TerraLunas fallout, check out the show notes for this episode. Unchained is produced by me, Laura Shin, with help from Anthony Yoon, Daniel Nuss, Mark Murdoch, Shashank, and CLK Transcription. Thanks for listening.